Every year, Europe produces world-class tech talent, and yet nearly every founder with global ambition still backs their bags for Silicon Valley. Why is it that despite decades of effort, Europe struggles to keep its best entrepreneurs? And what if the real problem isn't capital or ideas, but a hidden mindset gap that shapes the fate of entire regions? If you have ever wondered why billion-dollar companies keep emerging from the Bay Area, while so many European founders feel trapped by bureaucracy, this conversation holds the answers. Because what's at stake isn't just personal success, it's the future of how innovation, wealth, and talent move across continents.
But that making such a big shift, so much so that founders who are going to build in the US would actually not go to the US and stay in.
This episode dives into what separates those who build generational companies from those who get left behind. From the power law that makes or breaks venture capital to why relationships, not pitch decks, determine who actually gets funded. And how emotional resilience, not market timing, decides who survives the chaos of global tech.
You would basically be ruining all of it by not being laser focused on your core activity. Reputation. It's all about.
Today's guest, Enis Hulli, isn't just any investor. As general partner at E2VC, he's led investments in more than 40 startups, including 3 unicorns, helping founders from Turkey and Eastern Europe break out onto the world stage. He has lived the journey from summer houses in Istanbul to billion-dollar boardrooms, and he is here to share the raw, unfiltered truth you'll never hear on a panel.
And to get to the next level, now we're raising our third fund. It's a $100 million fund, which I can see how we're going to raise. Whether that fund can go from 100 to 150 million, I can see that happening.
So, if you believe the next great company could come from anywhere, or you are chasing your own impossible dream, this conversation will change how you see ambition, risk, and the real rules of the global game. But before we jump in, if you want to hear more industry leaders, top entrepreneurs, and world-class venture capitalists on this show, there is something simple you can do. Every follow, every like, every share. That's what helps me bring even bigger voices and sharper insights to you. If you want more of the best minds in the business, help us grow by sharing this episode with just one person who would appreciate it. Now let's get started.
This is the first time I'm doing this, so I'm pretty excited. First time
Really?
doing an
Really?
event over LinkedIn, that's also live, and over Zoom, but also recorded. So it's cool.
It's the first time that you do an event over Zoom.
I think so. Or maybe people don't even add me.
Oh,
Not,
really?
not over Zoom. Over LinkedIn, that's done on Zoom. So it's like a LinkedIn event. There's a LinkedIn event page, but then the streaming is over Zoom.
That's awesome. I think it's let me just think. I think it's 200 live streams that I did since the start of the pandemic.
Nice, nice, nice.
I love how technology evolved. I mean, when I think back 10 years ago, I think we were on GoToMeeting, which was, it worked, sometimes it didn't.
Yeah, true, 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 true. I used a couple of different pieces of software, but I don't remember their names. Yeah, I don't remember. This was like, yeah, pre-pandemic, me trying to do my own podcast era.
Agnes, where do you call from today?
I'm currently in our summer house, in southern Turkey. I decided to spend the week here, so it's my summer town, and then in 2 days we're gonna go to my wife's summer town, and then back to Istanbul. So yeah, this is me, like the pre-summer, spending my time in the summer town era.
Southern Turkey is beautiful. I mean, I'm a tourist. When I go to Turkey, I'm a tourist basically. So I know I think I don't know if it's still the biggest tourist hub, Side. It's in the southern part.
See there, yes, still is. I've never been actually.
I love the Mediterranean Sea. It's really beautiful. Yeah. But for me in August and July, it's pretty hot. in the southern part of
It
Turkey.
is. It is. It is. And then in like July, August, you try to go to the northern parts of it with also some summer towns. And then yeah, you basically, you immigrate. You go from south to north as the summer progresses.
What do you recommend for tourists when they want to spend the summer in Turkey? What is the best part for that?
Depends what they want. Like if it's partying, then it's Çeşme or Bodrum, I would say.
Mm.
Uh, if it's more like family life, kids, etc., then the summer town where my wife is from, Kalkan, is actually pretty amazing. Nature is great. You can have your own boat, go out with the boat every single day, and it's everything's much
Mm.
more calm. The city would sleep after midnight, etc. Then I would go for Kalkan, for example.
The city sleeps after midnight. Really, that happens today in summer.
Yeah, it's all older people. Yeah, it depends. There are different segments of it. It's like a mobile gaming company with different segments of users. So that segment of users, that's what they want.
Yeah, Turkey is huge, so you can segment the country for different types of interests.
Exactly, exactly.
So you grew up in Turkey, obviously.
Yes, so I grew up in Izmir, which is the third largest city in Turkey. I was born and raised here. I went to high school here, and then I went to Canada for school. So the first time I actually moved abroad was for college back in 2009.
Why, this was one question when I read your material that sparked my interest. Why Canada?
I was stupid, I think. I was going to go to the US. I actually made an early application to Northwestern for
Yeah.
Econ and Pulse. I got in. I was going to go to Evanston. But then my family is full of engineers and they were kind of mobbing me as to why I'm not studying engineering. And it was already too late because in the US, after you did an early application and you got in, you
Mm.
cannot reapply to any other college. You've actually basically accepted your offer. So I was left with Canada. And my uncle and my cousins live in Toronto. That's why I did U Toronto and McGill, got into both of them. And then the reason why I chose McGill over U Toronto was I think Montreal seemed to be a more fun city, more European lifestyle. I don't know, close to New York. I can go there whenever I want, was my line of thought, which is not true, I would say. So it was a bad call. But that was what I think, what I was thinking back in the day.
Yeah, this makes sense. I mean, Canada is a beautiful country and New York not far away per airplane.
Yeah, yeah, exactly. But yeah, I never went again. So I actually didn't attend my own graduation. I finished school, came back to Turkey, and never been to Canada again. So it's been 12 years. I mean, I liked my student life there, but I think that was it. I only liked my student life.
Student life is always great. And then you made an interesting pivot. Civil engineering, pressured by your family, and you studied in Canada. And then you decided to go into venture capital. What sparked this transition?
I was getting really so winters were cold. It's negative 20 degrees. You're in Montreal. You're freezing to death whenever you go out. So first year you can go out, party, whatever. First year passes. Second year I was obsessed with football, so I was playing all sorts of different football games, etc. Sure. Third year I was super bored. That's when I learned about the whole startup world. And my girlfriend back then, my wife now, lived in London, so I was going to London pretty frequently. I also didn't like civil engineering at all, so I wasn't going to school at all. So in London, I met with the startup world, learned about this thing that young people are building startups. They're founding companies, etc. So I joined a startup called Goodbuzz. It was a marketing technology based out of London. I was still living in Canada, but the co-founder was in London, so we were trying to build a marketing tech company for a year and a half. Didn't work out well. We were never able to raise a Series A, so that garnered my interest into the startup world while I was still in college. Post college, I did some mechanical engineering for like 3, 4 years, but I think I always had it in mind where I wanted to go back to the startup ecosystem because I vividly remember doing mechanical engineering in the eastern parts of Turkey in a construction site, but I would be listening to This Week in Startups, for example, in a weird remote location in a construction site. So I think I always had it in me that I wanted to go back to the startup world. I just didn't know how or with what role. And then it turned out to be venture capitalist.
How did that happen? How did it happen that you jumped into venture capitalists?
I think I'm too risk averse to be a startup founder. I think I would always be a founder, meaning I would find my own company. It wouldn't necessarily be a startup where it's high stakes, high risk, high return. I'm too risk averse for that. But to invest into people like that, I'm not that risk averse. So first, I wanted to start angel investing just to realize that my capital is nothing. So I tried to turn that into an angel network called First Seed, where I would
Mhm.
I've I garnered interest from people who are looking into the field, young people in Turkey, so that we'll all chip in 50K to 100K, 10, 20 of us, so that we'll be deploying 500K to a million, for example, in a span of 2 years. But while building that angel network, I met with 500 startups, and they had this model where they were growing internationally. They would enable GPs to raise funds with their name. So it would be, for us, it was 500 Istanbul, the first fund in Turkey. There was 500 Southeast Asia, Japan, Korea, Mexico, etc. So we made a deal, we made a partnership with them to do fund one. So me trying to build my own angel network quickly turned into me trying to build my own small micro fund.
When did your first fund start?
When did I first fund what?
When did your first fund start? Which year? Which year?
Oh, the fund is mid 2016. So I think mid to end of 2015 is when I met with 500. Beginning of
Mm.
2016 is when we started fundraising, and then mid 2016 is when we actually closed the fund. And throughout that time, I was also doing construction. So I was doing mechanical engineering, heating, ventilation, air conditioning. So during the day, I would be in the construction site doing heating, ventilation, air conditioning. During the night, I would be talking to people, trying to fundraise, go to incubation centers, go to accelerators, meet with startups, etc.
That makes me a little bit curious. You started your fund in Turkey, which is clear. I mean, you are from Turkey, so that you do something for your home country is quite natural. My question to you is, how did you perceive fundraising for a fund in 2016?
Comparing to today, there wasn't that many funds. There were only a couple of funds that have launched and raised their funds over the past 2 to 3 years. And being in the market, we were probably the only one trying to raise. So for people who are already interested in becoming LPs, investing into funds, it was really easy to access them and to have that first meeting because there weren't a lot of products or fund managers that they can look into anyways. And then our value proposition was different. Our value proposition was to invest into Turkish founders that have a global focus, if not a US only focus, which wasn't the case before. So all the existing funds were more focused on the hyper-local ecosystem or the economy of Turkey. It was the typical emerging market thesis where if you look into markets like Southeast Asia, Latin America, Africa, Middle East, etc., you would find that the first generation of success stories would be local Amazon, local Uber type companies. And that's what the investors were going for in Turkey. But our positioning was kind of different than that, where we were trying to anchor ourselves to the technology talent in Turkey while everything, so sales and marketing, fundraising, down the line M&A, IPO, etc., would only going to be in the US. So I think our value proposition made sense to that initial pool of backers.
Well, I think this is interesting. You started investing in Turkey, but already early you decided that all the sales, marketing, and IPO, if that is an exit strategy, happens in the United States.
So even
Why?
revenue, first customers happens in the US. I think you know
Why?
how it's first the ideology that sets the culture, that sets the processes in a company. For us, from an ideological and philosophical standpoint, we believe that VC only made sense if you're riding the power law. If you're not riding the power law, then this asset class stops making any sense. And to be able to ride the power law, you have to do equities in the US. Europe, even Europe, a very mature, rich market like Europe, failed to create a single decacorn in a decade now almost. So that tells you something. Whereas if you look into funds in the UK, which is much more connected to the US, Estonia or Israel, you would see that, these unicorns and decacorns are being born year in, year out. That says something. And we try to, I think, philosophically speaking, we believe that equities is a US game. And to make return in the venture capital space, you have to ride the power law. If both of these statements are true, then you have to play this game in the US.
So investment in your fund means that you take the company, a local company, and bring it to the United States at the end of
It's
the day.
50-50. I would say it's a two-way street. So half of the portfolio are founders who are already based in the US. They
Mhm.
want to employ technology teams back at home. And they see us as a bridge to back at home and talent operations back at home, etc. Whereas half of the portfolio are founders who are already based in Turkey or not based in the US, but they want to move to the Bay Area and they want to have their engineering team back at home, but they would be spending the majority of their time in the Bay Area. So that would be like an equal split of our initial portfolio.
What does your European soul say about this strategy? So let's just take you out of venture capital for a moment and look from the European or Turkish perspective, European perspective, Middle Eastern perspective. I mean, I hear this story all the time. We start here in Europe, Middle East, and then move to the United States because we need to play the game and the market is just bigger and you have more investors. What does your soul say about that strategy?
My soul and my consciousness is fine about that strategy. I think what's important is how do you want to play this game? If you want to play the game of blue ocean markets, so newly emerging technologies that are just getting being hyped about, you don't know when the market is going to mature. If it's a year, 5 years, you never know. Then that game is a very US game because you need high enterprise budgets, high R&D budgets. Enterprise software spending in the US is larger than the rest of the world combined, excluding China, etc. So that pushes you towards that. If you want to play the game of investing into more mature markets where you see how big the market
Mm.
is, you see the competitors, you know the nuances of and different differentiations that you can build as a company, whether that's on the product layer, go to market, customer segment, etc. If that's the game you want to play, you don't have to necessarily go to the US. But then at least in our DNA, we were more tailored towards blue ocean markets and founders who are building technologies in these very nascent spaces. There we're taking a big market risk. The market might never mature to be big enough or might get commoditized pretty fast with another big tech player. We're taking all of that risk. What the upside is, if the market matures, then you're very well positioned because you've taken that position over and over again, day in, day out for the past whatever, how many years. Since that's our thesis, if that's your thesis, and since that's our thesis, you have to play a US game. But that's not the only thesis in VC. There are a lot of different theses that, funds can build upon, and not all of them have to have this US bridging strategy.
No, that speaks a lot for the United States and a lot less for Europe, unless you're a PE fund, private equity fund. That's a different game then. But in venture capital, I totally agree to what you say. I mean, you have a lot of talent flocking to the United States from all over the world, higher valuations, more capital available, and it's
And
just
not
not
even the
here.
US, it's the Bay Area. So if you exclude the Bay Area from all of the metrics and look at US minus the Bay Area, compare that to Europe, Europe might even win in everything, in like number of talent, number of engineers, number of unicorns. But Bay Area has this super strong talent network effect where talented people want to be with other very talented people, and this flywheel effect just makes the difference a special place.
But why did this happen? I mean, I'm reading currently the book, The NVIDIA Way, written by Tai Kim. And
Mhm.
in the first chapters, he writes about the 90s when NVIDIA started. And at the beginning of the book, there are also companies in Canada that were pretty famous. NVIDIA started working with a German company, with a German chip maker back in the 90s. So also I'm 50 years now and grew up in the 90s basically and studied in the 90s. It all felt that the United States, Canada, Europe, European ecosystems are pretty much on the same level. It didn't look to me that they are so far ahead. And then Silicon Valley just took off. My question to you is, you know both ecosystems, you know the European ecosystems, Canada, London, Turkey, and United States and the Bay Area. What's your interpretation? Why is the Bay Area so far ahead? I mean, the last 30 years, it just skyrocketed. Why did it happen?
I think the venture capital in general as an asset class also skyrocketed. Startups building equity value in a startup and then taking that to the public is also like a 3 decade old strategy. And all of them just built more moats to the Bay Area as a geography. When you take those out, when you take the capital as a moat part out of it, when you take the public markets and the fact that startups can grow and IPO in the public markets out of it, and purely look at this as R&D and company building, but only those two components are still there, then I think these regions would be more comparable to each other, and that was the case a few decades ago. But then venture capital as an asset class, capital becoming a mode, companies, startups being able to go public while still burning cash, while not reaching profitability for years and years and years to become just $100 billion, if not more, companies just made it natural that one place doesn't have to be the Bay Area is going to have this flywheel, this self-fulfilling prophecy of becoming the place. And it happened to be the Bay Area.
Yeah, and they just keep the position. I mean, they have the capital now, they have the talent now, they have the big companies there.
Mhm.
And this is not much can happen that this really doesn't work anymore. When we look not only at the capital side, but on the execution side, how different is the culture in the Bay Area?
Mhm. From a culture standpoint, it's so different. I mean, in terms of people's times are very valuable in the Bay Area because they're imagine being a 10x talent, 10x engineer. Your time is very valuable. So what you're gonna learn for the next weeks or hours or months is very critical for you. So you wanna spend time on the technology that's gonna matter in the long term. or learn about it or build on it. That goes same to company building, where you want people who are very obsessed with their times, who want to work on particular technologies because they believe in the long-term value of that technology. And that goes to your customer relationship as well, where you want to talk to potential customers who are in turn are going to convert into actual customers. You don't have time to waste in any of that. But when the pieces of the puzzles come together, it makes it such that it's high trial, high failure. You would try again. Whether you would also switch jobs. You're not going to be stuck in the same role for years and years and years if you're not growing as a person. Everyone's looking for that power law, not just the VCs, but everyone from a talent, from an engineer perspective as well. But when
Mm.
the whole culture of the city is tailored like that, the risk-taking appetite goes way higher than what it would have been otherwise. And I don't like the lifestyle in the Bay Area, but people are only there I feel like people are there because it satisfies their ambitions, their passion, their purpose in life from a work perspective. And work is 80% of a lot of people's lives, and that makes a difference. And that's a complete different culture than in Europe, where work shouldn't be 80% of your life, or you shouldn't find your life's purpose in work. The moment you say things like that, and if a lot of the people, if you're a potential customer, if you're an engineer, if you're a founder, thinks like that, the whole culture is, just different.
In your opinion, is it possible to build a unicorn or the next trillion-dollar company with a work-life balance that is 4 days work and the rest is downtime?
It is possible. I mean, it matters. Is it possible to get from 0 to 1 like that? I don't think so. Is it possible to go from 1 to 10? Maybe. 10 to 100 for sure. I don't think you can sustain an unhealthy work-life balance for a very long amount of time. This should be, at least for me, it's more in sprints rather than continuous like that. It's more of a step curve function. So can you build a decacorn with a work-life balance as a founder? You can. Can you go to 0 to 1 like that? I don't think you can. I think you need that bump, you need that speed ramp in general.
Why is it so important in the beginning that the full focus on the task at hand?
Because other than first, it's only you as the founder. You are the company. You are 100% of the company, if not 150% of the company. The other people can be just, wouldn't be adding much value, but dragging you down as a founder. Sometimes even that happens. Um, but then over time, you build inertia. You build inertia where such that the company is not just you. I mean, you're just one component of it. And that's where, you having a healthy mindset becomes more important. Work-life balance becomes more important. Culture of the company becomes tremendously important. If you haven't done it correctly, it's very tough to switch, but not the case initially. That's why I think when you are the company and the company is just you, and that is the case for a while, then inertia is not there, and you being able to move fast enough, iterate, be obsessed with work, where when you're taking a shower, you're still thinking about work, etc., is critical.
Yeah, couldn't agree more. Alex Dang and Ilyas Rebulaev wrote in their book, The Venture Mindset, that on average, a VC, before they say yes, look at 101 pitch decks, which makes a nice number, 101. When you talk to founders from your region, what makes them investable for you?
I think it's broadly speaking, we have two types of founders in our portfolio. Founder type one is they're uniquely positioned in their field. They've spent 10 years on data streaming technologies. They've spent 15 years building in the observability space, building a logging protocol, for example. And just by their CVs on the face value, you can understand that they're one of the top 10,000 people in that field. And then speaking with them, it's easy to qualify whether they're top couple thousand or not. I think that qualifying that, picking part of that piece is not that tough. It's easy to do. Um, because they're uniquely positioned in their field, how many of those top few thousand people are going to become founders? 3, 5, not more. And then how many of them are going to be able to attract venture capital money to be able to turn that into a larger company? So there, I think access is tough because these are top tier people, but picking is easy. And you don't bet on their entrepreneurial approach. Of course, they have to be entrepreneurs. They're building companies, but at the same time, their minds don't have to tinker all the time because they know what they're going to build, and they're very good at that. They're one of the top 0.01% in building that anyways. Whereas this other half of our portfolio are founders where they're not the top few thousand in their field. They're just getting started. That's where there's a current ability and there's a potential ability. And we're betting on the fact that the founders are gonna surround themselves in an environment where they can seize that upside potential and reach their potential ability. They're not top few thousand, but we believe in their entrepreneurial approach. We believe that they'll be iterating so much for a few years that they're going to grow as a person, so they're going to become uniquely positioned in a field just because they spent a couple of years in it, and they're going to tweak every single part of the business model. They're going to play with every single lever so that eventually it's going to work. Here we're taking a big bet on their entrepreneurial skill set. Here we try to qualify entrepreneurial skill set more because it has to be 12 out of 10. It has to be tremendous well. And then everything else should be obviously 8 out of 10. Whereas on this part, their unique position, it has to be 12 out of 10, but you can compromise a little on their entrepreneurial spirit.
That's a good point. When we focus on the pitch decks, I mean, also assume that you get a lot of pitch decks in your inbox. What's the one thing that you want to see in a pitch deck that makes you stop and say, I get them on a meeting?
Putting the founders aside, because normally I hate looking at pitch decks. All I do is I go and look at founders, and if the founder is interesting, I meet with them. I don't
Mm,
go through 15 slides trying to understand what they're building. It's either because founders are the only thing that get us from zero to one.
mhm.
And then we look at everything else, whether it's going to get us back from one to zero. So if we're looking into the market, competitive landscape, metrics, financials, any of that, it's because we're already bullish on founders. The founders were able to get us from zero to one, but we're looking for reasons not to invest. And I think 50% of the time we find those reasons and we end up going back to zero. But first, founders need to get us to one. So the only page on the deck that I look at is actually the founders. And then I even stop looking at that. I go to LinkedIn. I do my own 5-minute research online to, you know, validate the founders and then want to take a meeting.
This is my next question to you. I mean, when I look on LinkedIn today, everything revolves around pitch decks. So when I look at advice on LinkedIn and all these acceleration programs, incubation programs, I think 90% of the content is how to design a pitch deck that investors invest in you. And then a real investor, you say, forget it. The most important thing for the first step is the founder. Do I believe that they can make it or not? Why is the industry, or why does it look like that all the content created is so much focusing on pitch decks?
I think pitch deck is good because it gives you the clarity. I mean, it gives you a data point for you to further validate the founder. When I take that first meeting after validating the founders, before that meeting for 15 minutes, I go over the pitch deck, but
Mm.
not to understand what they're building. I don't care that much about that, but to be able to ask pinpointed questions and go into their brains, their line of thinking. How they view the competition is one piece of it, but then how they view the actual market. If there's a go-to-market slide, why have they put it there? If it's very weak, if it's very generic, a lot of the times you don't want anything on the pitch deck to be ChatGPT, meaning like it's generic. The moment it becomes generic, I needed a GTM slide. That's why I put it there. Type. It says something because I
Mm.
think less is more. It's better if that slide never existed in the first place. And if the founder says, I have no idea about the GTM, so I just didn't put it, it's a much better. It shows you that the founder is able to work around that ambiguity and not try to find these very custom standard answers that never stick. So a lot of times pitch deck matter because it gives you those initial questions, initial parts where you can then pull and learn more from the founder and how he or she is thinking.
Yeah, I think it also helps founders think the case through. And I mean, even if it looks generic at the beginning or a business plan, you just have a template, but it really forces people to think through certain positions and come up with ideas.
Yeah, some pitch decks that are so as a fund, we try to do portfolio support, but the one thing where we're good at, I think, has been follow-on funding, where our portfolio raised about $3 billion in follow-on funding. And we try to work with the founders to raise those A rounds, I would say a year or 2 years after we invest. And regarding the pitch deck, sometimes it's so crystal clear at a founder's mind that pitch deck takes 15 minutes to build. It looks very ugly. No one cares because it's very nuanced and the real information is there. A lot of our companies raised, $5 to $10 million rounds with pitch decks that were prepared in 15, 30 minutes max that looked very ugly, but gave the real data points where the founder wanted to convey into a potential investor.
Yeah, I think also the case matters more than the layout of a pitch deck. The case must make sense.
Yeah,
How important is an exit strategy to you?
so not important. I mean, maybe our LPs don't like me for it, but in general, I mean, I don't think the best companies are sold, they're bought. So a lot of the times we don't want to talk about exit strategies because A, it changes along the time a lot. B, it's not a core founder skill set. It can, I mean, you can get that skill set 5 years in. The moment you become a after you become a 10 million ARR business, you can start thinking about who's a strategic buyer, why, etc. If your business stumbles, because businesses do stagnate, and at these moments of stagnations, these existential questions obviously come to founders' mind, and we want them to be able to start thinking those when the time comes, not as an upside scenario, but more like a downside protection scenario. But it's not important 5 years before while they're raising their pre-seed rounds. In fact, if the founder has put it in her pitch deck, or if she's mentioning about exit strategies, etc., it becomes a 10-minute conversation where I start asking questions about their long-term ambitions, about their resilience, about their perseverance, stamina, etc. So it brings all of those question marks, even the fact that he or she is thinking about it.
I have always a problem with an exit strategy when a founder or an entrepreneur or a CEO talks about it. Got my training in the 90s in business schools. And usually what I expect is, or what I want to see is that people are passionate about building a lasting company. As you said, I totally agree to what you said. An acquisition happens. So if someone wants to buy a company and it's the best way forward for the team and the idea, of course you make it, but it should not be planned, in my opinion. And then I see pitch decks today also on LinkedIn with, in 18 months we sell our company. In 5 years we start the next company or something like that. Uh, how does it make sense to you?
No, it doesn't. And I really don't like that mindset. Because also, again, going back to the power law example, riding a power law, trying to build $1 billion, if not $10 billion company, there's no way you can foresee who's going to buy you 7, 8, 9 years ahead of time. I mean, let alone you don't know what the technology is going to look like tomorrow. You don't know how the pendulum is going to
Mhm.
swing. So you don't have time to think what's going to happen 8 years from now from an M&A perspective. Those are the types of founders that we want to back. And if this was my own money, if this wasn't the LP's money, there are some companies where I would want to stay in forever. I don't like the fact that this asset class has a firm fund life cycle.
You mentioned looking into the future, 9 to 10 years. What's your take on predicting the future as a venture capitalist?
I'm not that. I'm really not that. I mean, our thesis has been to be founder first, and the moment you become founder
Mhm.
first, you don't become thesis first. Um, you start following great founders who, in return, put you into certain theses. Yes, for example, 2016, 17, 18, we did 10 investments in health tech, two of which became unicorns. It's not because we had a big thesis on health tech. It's more so that we follow great founders, and great founders turned out to build in the health tech space and during that era. 2019, 2020, 2021 has been a lot of dev tools. 2021 onwards, 2022, 2023 has been a lot of AI. You would see that 50% of our investments have been in AI. And then we had this Turkish mobile gaming throughout from 2020 till 2025. It's not because we had these ground theses around that, not really. And I think if, let's say you got bullish on AI, 2020, you're very bullish that AI is going to come. Worst thing you would do with that unique insight, with that unique asymmetric information, is to try to find pre-seed opportunities in Turkey that you want to back. You can go and buy Nvidia stock and you would make whatever dozens of X's instead. That's why. So we're not thesis driven at all. We're very founder driven.
Yeah, I totally agree. I think predicting the future in investing is so hard, next to impossible. You mentioned Nvidia, for example. I mean, even when I look at a public company like Nvidia, I mean, now everybody loves Nvidia, and now Nvidia is the big success story. And Jensen Huang is, I think, basically the number one hero in entrepreneurship. 2018, Nvidia was just a commodity company, chips. Nobody needs chips. And I think they lost 60 to 70% of their stock price within a few weeks. And nobody loved it. AI changed everything. So predicting the future, I completely agree to what you say, is really hard 10, 20 years into the future. Founders first makes sense, but what are the character traits? What do you want to see in founders when you look at them? What are the three most important points they need to check off on your list?
Mhm. First off, I think is the table stakes part. So the easy part is if they fall into this one category of having that unique insight into one
Mhm.
space, I try to validate that. Or if not, if they fall into this category, then I want to validate their entrepreneurial skills and entrepreneurial ambitions. That's easy. Second part is a founder that has a low opportunity cost, meaning they just started a business, they have nothing to lose. Anything is just going to look better if they survive over the next couple of years. Those founders tend to have a very high risk-taking appetite because they've got nothing to lose. Of course, they're risk-taking. But 3 years, 5 years in, they've already sacrificed a lot from their lives. They haven't seen their husbands, their wives, their kids, etc. It's been 5 years. The company is now a 50, 100 people company doing a couple $1 million in revenue. So there is something to lose. There is more inertia there. And their risk appetite goes lower naturally. Obviously, we try to build in schemes where to uplift their risk appetite high. For example, do more secondaries, make sure that the founders also get some cash out so that our incentives become aligned where we're trying to, ride the parallel, make this a generational company so that they're not, conservative at their approach. It works, it doesn't work, but it's very tough to gauge. There we're trying to understand the core motivations of why they want to build a business. And this goes back to their childhood traumas, relationships with their dads, relationships with their environments, um, all the issues they have as to why they want to sacrifice the next 5, 10, 15 years of their lives into building something, if they want to sacrifice that. Because if they're in it for the money, it's a good motivation as long as they need the money. The moment they go off that threshold, there's a hurdle. The moment you jump that hurdle, you're motivationless. And it happens to us. I would say half of our portfolio are founders like that, and it's very sad for venture capitalists because all the stars would be aligned. And it's very tough to get those stars aligned. But the one star, which is founders still having that ambition and the risk-taking appetite to go another 10x, might not be blinking. And then the company, stagnates, becomes a tech SME. And we have a lot in our portfolio. So to validate that, you try to go to the inner core motivations of a founder. And I think that's the humane part. That's the more psychological part of it. I'm not saying we're great at it. We're for sure not. I think gauging a founder's unique insights, it's very easy to do it with a 95% accuracy. Gauging a founder's entrepreneurial skill set, it's very easy to do with like 80% accuracy. And with that 95 and 80% accuracies, you'll be fine from a picking perspective. If you've already solved the access problem, you'll be fine in picking. But then this grander ambitions, grander inner motivation, etc., I'd say we're 50% from an accuracy perspective.
Let's stay a little bit with founder personalities. What you mentioned makes a lot of sense. When I look, for example, back in the 90s in the business schools, it's the normal life cycle of a company. You have an idea, put a team together, you start, you take off, and then you peak, and someday the company just vanishes and is replaced by another company. And I always thought this happens to every team. It's natural way of life. It's like spring, summer, fall, and winter. And then there are these personalities like Jeff Bezos, Jensen Huang, Elon Musk. Jeff Bezos, for example, started Amazon as a bookshop online, was nothing special back then. A lot of companies did it. A lot of companies vanished, but Jeff Bezos then said, no, let's not stop with books, let's make it a marketplace. And then after the marketplace came AWS. He placed a lot of bets internally, many failed, some worked
Mhm.
out. In your opinion, when you look at personalities, have you found a method to distinguish these special types of personalities who are never satisfied, who always keep going from the other ones? What makes the difference?
So in that, the natural course of life, going from winter to spring to summer, etc., and that companies eventually die. Obviously, when you take n to infinity, everything goes to zero. Um, it's fine as long as it doesn't happen because of founders' inner motivation and
Mm.
inner spirit and inner drive. I think that's one thing where we're trying to increase our accuracy on because we can't control all of it. You can't control if a lot of the times founders do everything super well. They also have that inner core still on fire, burning. They have that risk-taking appetite, but something else happens from a tech inflection, competitive move, regulation. Anything can happen, and you can't control it. So our goal is not to control those things happening from externalities. We're trying to control those things happening from an internal founder's mindset perspective. And yeah, we're not even good at that. So let alone all these externalities that you have to focus on. If this is a long game, a fund is a 10-year fund. With 2-year extensions, it becomes a 12-year fund. And I don't like it. I don't like that fact that it's a closed loop fund. If you ask me, it has to be an open loop fund, which makes, n go to infinity. And the
Mm.
fact that everything goes to zero is a risk. But I think with technology, there are different modes that didn't exist before. So it's hopefully going to take a longer time for these $1 trillion businesses to, go to zero.
Yeah, you just need to catch the apples, alphabets, metas very early and just stay in it for the very long game. And the rest comes by itself. I think the hardest point is just to find it and then staying in it. And with a 12-year fund,
With a functioning public market, I understand the closed loop funds because eventually everything ties back to an IPO. You either want to IPO a business or you want to sell to a company who has IPO'd, or you want to sell to a company who's going to sell to a company who's IPO'd, etc. So there's the value chain goes towards there. But when there's a clogging from an IPO perspective, then the whole business model crumbles because of fund life.
Mm.
Um, because when if time is to your advantage, everything is great. If time is your disadvantage, it becomes your biggest enemy. And I think a lot of the funds, we're not there yet, but we'll be there in 2 to 3 years. For a lot of the funds, time became an enemy.
Yeah, I totally agree. I mean, my favorite scenario still is building a company towards an IPO because it makes you bulletproof as a team. If you go for an IPO, you need to check off a lot of boxes. And by doing so, if the business model works, it becomes bulletproof. If you don't aim at an IPO, then you have very often problems with compliance and people just don't take it serious. And this becomes later a something they stumble over it. But with this 12 years fund period, I think one of the problems is when you have a bad market for an IPO and you need to return your fund, you need to force your companies basically into an IPO and can't hold them back. Is there any solution to that problem?
So not really, and I think a lot of the people are gonna hit that wall. I mean, the music stopped a while ago for venture capital. I think after 2020, 2022, music stopped. But I guess after the music stopped, we continued to sing. So we continued to dance and sing, all of us, because there are capital calls, money is coming in, management fees being paid, etc. So although the actual music stopped, the market didn't wasn't able to, go smaller. And then the large companies, large unicorns, etc., they had to stay afloat. So they raised funding in these very absurd terms with very high liquidation preferences,
Mhm.
etc., just to be able to stay alive, which in return pushed the VCs to stay alive as well. But now there are two pressures that are actually coming. One is the liquidation pressure of actually returning money and doing DPI and the situation of the public markets. And number two is they have to raise their new funds, otherwise they're going to be out of market. So I think next 2 years we'll see, half of the unicorns die, half of the VC funds not being able to raise their new funds, etc. And it's just natural. It has to happen.
Yeah, valuations are pretty high, but now the IPO markets are back, which is basically a good
And they're
thing.
not back yet, but they think that they're gonna get back in the second term for Trump. So
Mm.
if you have this assumption that IPO market is gonna be back, say in 18 months, and there's this demand of lined up of all these great companies that have raised a lot of funding from legitimate sources who've been looking to do an IPO for the past, 3 to 5 years. The easiest thing that comes to mind are SPACs, which might mean that SPACs are gonna be back. I don't know. That's what it looks like.
There's a lot of financial engineering on the market. What I never understood was what's the benefit of a SPAC?
Yeah, I mean, in this case, if you think public markets are going to look better in 2 years, plus your company is going to look better in 2 years, and if you think that the public thinks that, it starts making sense to,
Mhm.
grab that pool of public funding and then have another, whatever, 18 months, for example, to go public at a flat price with not enough public disclosures. I'm not good at this from a financial engineering perspective. I suck at it. Even in our portfolio companies, I think going from 0 to 1, I'm very passionate about it. It's not like we support a lot, but at least I'm interested in what's happening in a business. The moment it actually becomes a business, there's inertia. It's a 50 people company doing a couple $100,000 monthly revenue, etc. And then there's all these financial nuances, etc. Yeah, my interest fades.
Yeah, no, I mean, if I think the SPAC makes sense for investors when they don't find a target to invest in, they can just structure a vehicle and then invest later. For the company, I think the IPO process was never a problem, so it is the easy part. But when we go back to founders, and we are in the early stages and they start with the journey, I think there have been a lot of mistakes when reaching out to VCs. What are the three biggest mistakes that you see when you interact with founders that they could easily fix if they knew it to get a better success chance when pitching VCs?
I think from a grand scheme of things, from an ideological standpoint, they have to spice the deal up, which means
Mhm.
that they are unique. VC is not. Money is a commodity. Their company is not. So you have to, as a founder, you're trying to give the message that the VC they invest today, or they're never going to be able to invest again. Whenever a VC feels that they can invest into this company a year from now, even if they do super well, even if the valuation is 4x of what it is today, if I know that I can invest, then I wouldn't invest today because time becomes my average and I can price it. You have to make me not be able to price it. If I've lost it, I've lost it forever. And then going back to your question into advice, all of the advice I'm going to give is going to be around this umbrella. For example, doing massive email reach outs to a lot of VC funds, etc., makes the deal lose its spice. Or making me feel like I can get this deal whenever I want by, trying to build a relationship, sending emails over and over again, etc., makes me feel like this deal is not spiced up. I can get into this deal a year from now, even if they do super well. And then also in the meeting, not pushing me to a decision, 0 to 1 decision, makes me linger. And if I can linger, time becomes my advantage. And you don't want that as a founder. You just want me to say yes or no and then move on with it because there's a lot of VC funds that you can speak with. So for a lot of first-time founders, especially, they think from this as a relationship building business where they have to really build relationships with a VC. So they email and email and email and email, and a lot of the times I think it just makes a VC lose her appetite.
Really, you think this makes VCs lose their appetite?
Yeah, because I mean VCs are triggered by FOMO. VCs are very risk averse. A lot of them have moved into this industry from financial markets. They're
Mhm.
not entrepreneurs. They're so risk averse, and they only make a decision if they're pushed to it and they're FOMOed into it, etc. And you have to make sure that they're FOMOed and pushed into it.
But this is basically a sales game then at the end of the day.
100% sales game. It's a sales game where you have to make sure that you only have one product and one person is going to buy it. It's not like you have 10 of it and you don't care. I mean, it's very psychological depending which VC you're speaking with. If you treat them with a high respect and they're, entitled to it, it might be good. But for funds that are, if you're building in a space where Andreessen has an edge in, and you're speaking to a partner who's, building in that space, for example, the data team at Andreessen, then obviously you have to treat them with that respect because they've earned that respect by investing into a bunch of unicorns in that space. But if not, then you have to treat them like commodities. And a lot of the founders that I like see VCs and the capital is just a need, as a hurdle they have to jump, and they do whatever they can to jump that hurdle. Eventually, it's the money that you need.
Mhm.
Obviously, things that come with it are good. All the support, positive signaling, brand value, etc. obviously do matter, but doesn't matter, as much as the funding that comes with it.
That's an interesting point. So basically, your recommendation is treat it like a sales process at the end of the day. When you speak with a VC, see the human and play an emotional game with them.
100% make them speak. Make them speak. Don't pitch the
Yeah.
whole thing. Try to turn it into a conversation where you try to understand their hidden biases in their minds so that as you're talking about your business, you'll only pinpoint to those specific points where you think they have biases. You don't have to go through the whole thing. If they don't have a question mark about the market size, don't talk about the market size. um, you know, and from a sales perspective, push them to a decision. They either buy or they don't. They can't linger, and make them feel that you're the type of founder who treats everyone like that because you want to move stuff. You want things to move. You don't want any clogging in any parts of your business.
So if I interpret what you say, so it would basically be a mistake to say, you have the pitch deck now, we have spoken, take your time and think it through. And when you're ready, then come back to us. You would rather recommend a way we say, look, I want to move forward, my team wants to move forward. How long does it take for you to make a decision? Three
Exactly. Make
weeks.
sense. I think a very condensed sales process is good. So 15 days, 20 days, talking to 100 VCs, it's good. But very condensed. The more a deal is on the table in the market, you hear about a deal 2 months later, you hear about it again, etc., creates this negative signal, which makes the VCs lose their FOMO. You have to
Mhm.
play the FOMO game.
What do you think about separating the deal phase from, let's call it a marketing phase or relationship phase? Because at the end of the day, to understand biases, you need intel about the VCs. So my advice to a founder would be reach out to VCs, meet VCs to understand what's the sweet spot. Do they have money to invest? Are they actually investing? Are they divesting? To understand their biases. Uh, how do you see this approach? Is this not good? Is it good?
Yeah, I think they should know I mean, learning about the vintages of funds, their deployable capital, etc., has to be more easier to grab, either getting intelligence from other founders or doing an online research. Because trying to I understand. I mean, we're fundraising for our fund as well, and to get one LP interested to a meeting takes an effort. You do a long list of 100 people you want to meet. From that 100 people, you find 200 connections so that you would ask two for each one. From that 200 messages that you've sent, hopefully 30, 40 of them are going to turn into double opt-in intros. And then from that 30, 40, hopefully 10 would want to meet with you. So you're having 10 meetings after all that effort. Um, the point, the point that I'm trying to get is if you do all of that process for unqualified leads, so funds who potentially might not have any deployable capital left, who are in between vintages, etc., then it's just so much work. I think you have to do that homework before you meet the fund. And then asking about the fund's approach is good because it makes you seem like a founder who has options and who's qualifying which fund to take into the round because you have options. But then those questions have to be more nuanced and to the point, not like how big is the fund, how much have you started deploying, what's the vintage? Those are like easy data points to grab.
So qualifying makes sense, and teams basically should do that at the end of the day. But when they start fundraising, when they send an email to raise funds, they should put a time ticker on it and say, we want to be done in 180 days, 90 days, whatever.
So saying that makes it like a goal. It has
Mm,
to look like a reality rather than a goal. And the way to do that is again, is like a sales process. But if someone books a meeting, if you email today and they book a meeting for 12 days from now, it's a long time, 12 days. In the 12th day, you should be like, there are some funds who are interested, who are already in the data room. I can send you the data room, but I would need a decision next 3 days,
mm.
etc. So it's not like sending a time ticker email. It's your approach, the way you frame things, the words that you choose that signal that.
Okay, okay. So everything time frame matters, even in VC
Yeah.
world. Good. I learned something new. I learned something new. I always thought in the bigger the tickets, the less important are time frames, but obviously it's not.
Yeah, no, I don't think it is.
Okay, so sales skills is something that founders should have at the end of the day.
I mean, they sell to their employees, they sell to I mean, eventually it's a sales game. So you have to be good at this part of it as well from a sales
Mm.
perspective.
Yeah, no, absolutely, absolutely agree to that. Um, when people use direct messages on LinkedIn, what, how should it look like in your opinion?
So getting a direct cold outreach to a
Mm.
VC has a very low conversion rate. When you look into the investments we've done so far, and we've invested into 75 different companies, how many of them were through cold LinkedIn outreach is zero. Hypothetically, it might work if I knew about that, if I knew of that person and she knows about me. If that's the case, then it's not that cold of an outreach because we're in mutual circles. So it makes sense that she didn't bother to find a mutual to reach out to me, but she just messaged me cold out, right? Then it would work. But if it's like we're not in any of the circles with each other, if we don't know of each other, it's a right cold LinkedIn outreach. If it looks good, if the founder's pedigree is good, I would want to get a first meeting, not myself, but maybe someone from the team. But the chances of that converting is super, super low. So my advice is if you know of me and if you think I know of you, cold outreach would make sense because why bother? But if not, then it's much better to go through a mutual.
So warm introductions still matter today.
100%. I mean, all of our investments have been through warm introductions and mostly not warm introductions to VCs because VCs are incentivized to do warm introductions. They're already on the cap table of a company. But warm introductions through other founders, operators, etc., are where bulk of the I dissected that, but I think I'm making this up right now, but I looked into it back in the day. Out of our 75 investments, about 40% of them were founders that we already knew from before. About 40% of them came through mutuals. About 20% of them were our cold outreaches, where we cold outreach to that founder to our data-driven stack, whatever that means.
I always thought warm introductions are something that is part of social capital, and you naturally play that when you see a company and know a VC, and you think they have a lot of overlaps. Naturally, you make an introduction, and then I learned, I think it started 10 years ago, that there seems to be an entire warm introduction industry, which I always found a little bit confusing, where companies start reaching out and say, "Look, we pay a success fee when you make a warm introduction,"
It's an
or
immediate red flag for us. The moment there's an intermediary in between who's doing the introduction, for me personally, it's an immediate red flag because it's so easy
mm,
to me. Why bother with an intermediary? And I think for a founder, this is like marriage. You want to build that relationship yourself. You don't want to outsource that relationship building part.
Okay, no, totally agree to that part. It's good to remind people that do it yourself or do it through real warm introductions and not hire an intermediary who just puts you in a catalog and sends it around to as many VCs and hopes for a lucky shot.
Mm. Those also it commoditizes you. I mean, working with an intermediary, and intermediaries do send us emails every now and then, just makes you one of the eggs in that basket, you know? It's
Mm.
like some VC funds also do it. I hate it. Some VC funds would send these periodic emails where like companies in our portfolio who are fundraising, and there would be like a list of 8 companies, for example, who are fundraising. It commoditizes the opportunity so badly that you want the other part, you want the other potential investor to feel like you're sending her this deal because of whatever reason you have, because you think it would really fit their thesis, blah, blah, blah. But you've actually given some thought and you've only selected a handful of VCs where you want them to participate in that deal, and you're just sending it to them personally, not making an email blast to, 100 different connections that you have, because everyone has VC connections. Everyone has 1,000 VC connections, but try to pick and choose which ones are the best for which opportunity.
But isn't that a little bit how should I phrase that? Isn't that a little bit the result of the data-driven phase that we commoditize everything, put everything into lists and send lists around and care less about relationships, while for VCs, and you mentioned it, relationships matter.
This is its own. I mean, the only thing that matters is the relationships. If you like take everything out of our business today, everything out of it, the track record, the pedigree, the LPs, the capital, the team, the branding, take all of it out. Just leave me with the relationships. It's so easy. Give it a year, it's going to look like the same. Do the opposite, where everything stays the same, but the relationships are foregone. It will take another 10 years to get there.
Yeah, yeah, that's true. That's true. That's true. Honor the relationship at the end of the day and
Yeah.
focus on that and never forget. I mean, this is why I'm not so worried about artificial intelligence replacing people. It's always a human game at the end of the day. And all companies that had the approach, I take all people out of a business, then there is no business anymore.
Yeah, it's a very personal and emotional business as well. I mean, if you're a bank, you're trying to give debt, if you're trying to give a loan as a bank, and you're getting a mortgage for your house, for example, you don't care which bank you work with. You look at the rates, which whoever
Mm.
gives you the best rates, you choose, because for you it's a commodity. You just need the capital and the best payment terms possible. But moving on that spectrum from getting a mortgage to doing an equity investment on a pre-seed opportunity turns that into a marriage. You might claim that any equity deal is marriage. It's not, because when you're when you're a Series C company and there's a Series C fund investing, to 15% of your company, it is a marriage, but it's a marriage with the company, not with you. Whereas here you are the company, so you are the only thing that matters in the equation. So it becomes a very, very personal game.
Yeah, completely clear. I think even with loans, with mortgages, I think even that matters. The interesting thing that I observed from human psychology standpoint is now with social media, yes, at the end of the day, interest rate matters, and maybe this might be the first part that people look at, but then they get on social media, then they find who runs that bank in the end of the day. How do they think? Do they have the same values like me? For example, I mean, we have a lot going on politics, and do they think climate tech matters, or are they more from the other side and think the oil industry matters? And I think these little nuances become more and more important, especially when people put more content on social media.
True, 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 true. I think there the difference is it's not personal, it's the firm and the
Mm,
firm's and what the firm represents,
mm,
from
mm.
an ideological standpoint. I hope VC becomes like that too, because for some VCs, it is the firm is much larger than the individual. But at least smaller VCs who are, sub 10 years old, etc., it's more personal than firm. The moment it becomes firm, then you've built something bigger than yourself, and I think it would feel amazing. But for a lot of the VCs, it's not there yet, because it's just, yeah, all of us are trying to prove ourselves, basically.
That's true. That's true. When we look at your career as an investor, I'm curious to learn what was your first investment? What's the story behind it?
Our first investment would be Carbon Health. This is a health tech company in the US, became a unicorn, raised $1 billion to date. But when I
Cool.
started venture capital, Erbil, who's actually now one of our portfolio founders, this company called Huma in the crypto Web3 smart contracts space, But Erbil was the first advisor to the fund, and back then he was doing personal investments, and one of them was Carbon Health. And we agreed that the moment we raise the fund, we're gonna get that asset into the fund on cost. And while I'm fundraising for the fund, I was pitching that deal because there were two deals that we already did. One of them was this one, the other one was a dev tools company. And now with Carbon Health, the company pivoted a dozen times. I mean, it started as a patient engagement solution, it moved into an end-to-end clinic solution with the software. Founder realized that this is not working out, so he decided to build his own clinic to better understand the needs. So we end up having a clinic in downtown San Francisco where there are actual doctors, and it's a clinic. And then he realized that to grow this brick and mortar business, he needs to do mergers and acquisitions. So became a very acquisitive company. It would be buying small clinic chains around the US, and then obviously became a unicorn. My learning there was Eran, the founder, was actually the founder of Udemy before, which is company that went public in the
Mm.
education space. He went from the education space from a personal itch. His personal itch was that growing up in Turkey, he had to walk miles and miles at snow to a school that only had one room. It's a one-room school where students in the first, second, and third grade would be bundled into one room. Schools in the fourth, fifth, sixth grade would be bundled into one room, and they would get the same education because there are not enough teachers. So that made him become very passionate about making education much more accessible, obviously using the internet. And then going into the health tech space, he had a personal issue with his mom's health, which pushed him towards the direction of like how everything needs to be much more integrated and embedded in health tech, so that you would be doing your tests, you would be going to the doctors, etc. Everything has to be in one space from a software layer perspective. So he built the software layer. Turns out there's no adoption for it, so he had to prove the point himself by building a clinic chain. It made me understand the importance of the founder, importance of pivoting. He not only pivoted the industry, I mean, from a personal level, going from education to health tech, he also pivoted the business model multiple times. And starting my journey as a venture capitalist, I would say 80% of my decision making was founder focused. Founder gets you 80% there, but then you look at everything else, it became 100% afterwards. So I think 2018, 2019 onwards, I, I mean, in the company, whenever we're discussing deals with my partner, we only discuss founders. We try not to touch anything else. So we don't look at the competitive landscape, oh, but their metrics are good, their financials are doing super well, etc. We don't talk any of that.
Carbon Health was founded by the founder of Udemy. Did you understand this correctly?
Yes, so the founder of Udemy, after being moved out of Udemy, started Carbon Health, and we did the pre-seed back in 2016.
2016, that's a long time. And it became a unicorn again.
It became a unicorn in 2020 or 2021. It was COVID. I vividly remember. I was in my study room. Carbon became a unicorn. I got out of my room and my wife was there in the living room. I was like, darling, we're rich.
Cool.
Apparently, not the case because VC doesn't work like that. But
Mhm.
I vividly remember that moment.
Yeah, but it was one of the first investments with your fund that you got
It
into
was
your
the
fund,
first investment. Yeah, it was the first investment of the fund.
and it directly became a unicorn.
Not directly, but like 4 years after.
Isn't that amazing?
Yeah, it was. I think it really helped us in. So it was the first unicorn of the fund. And then two others followed, Billion to One and Insider. But Carbon pushed us to be able to do the second fund while raising the second fund. And then throughout that fundraising process, first Billion to One became a unicorn, and then Insider also became a unicorn. But yeah.
I think I'm just thinking about the rate. I think it's less than 1% out of less than one of 100 startups become a unicorn at the end of the day. So it's really a rare event that you can be proud of that to make the first pick and exactly nail it what many VCs want to have.
Yeah, when I look into the companies that we've backed, they had to have that have a unicorn status, and there are four of them. And let's also count the ones that are 100 million plus. There's another six, seven there.
Mhm.
So it's a pool of like 10, 11 companies. And you're trying to understand patterns, in terms of the access to the deal, founder persona, picking, etc., all of it. So the whole value chain, there's no pattern. It's so sporadic and so unpredictable that you can't. There's so much randomness involved that I can't actually pinpoint into one thing that mattered the most. And Carbon was also like that. Was it my connection? Not really. Um, the fund wasn't even there yet. Did we have a great brand where we were able to get access to that very competitive deal through our brand? Not really. So yeah, I think it's impossible to find any patterns that where you can, push through, multiply, leverage, that's going to take you to the next level.
So there is no pattern at the end of the day. So even after investing in multiple unicorns, there is no real pattern that you can just put in an AI and say, this is the pattern. If a company checks off all of these criteria, we get a unicorn 10 years later. There's
No,
different.
definitely not. The moment you think that, you just created another blind spot for yourself, and 3 years later, you'd be like, "Oh, that was the blind spot I created, and that's how I missed this one deal."
I
The
read
worst thing is the worst thing in venture is creating those blind spots, is what I think.
I read so much on LinkedIn these days about how artificial intelligence will disrupt the investment process of venture capitalists. But in my opinion, if there is no pattern that you can use to identify the next unicorn, how useful is artificial intelligence then?
And like if for a VC, if there are three pillars, there's the access part, there's the picking part, and then there's the support part.
Mm.
And building, when people are talking about the fact that AI can replace VC, they're only focused on the picking part, which for some funds might be very important. Maybe if you asked for some funds, it's 80% of where the value lies, and then the others are in total 20. For us, it's not the case. I think for us, 80% of the value is that access part of it, because you're trying to access that top 1% of founders. If you're not able to access them, then it doesn't actually matter how well you're trying to pick out of the other 99%, right? So for us, we think it's an access game. So 80% of the value is in that access part of it, and that's not something that an AI can mimic.
So it still will be a human game in future.
Is what I think. As long as access to capital stays as is, it's a human game. If the market changes drastically and it becomes like mortgage, where the market grows by another 100x and capital is readily available everywhere, then it might get more commoditized, less personal, less humane, maybe, but I don't see that happening.
Yeah, me neither. Me neither. When we look on the other side, success, it's always great to talk about success stories. What is your biggest failure story?
In our portfolio, we had multiple failure stories. I mean, obviously, some of them went down big, some of them went down not so big. I'm thinking which one I should pick, but there was this one company where the company raised only $1.5 million and it was going head to head with a US public company. Founder moved to the US. We pushed him to fundraise. We were like, you have to fundraise, you have to fundraise, but he's not American. And he wasn't able to build great relationships with a lot of the VCs in the Bay Area. So he procrastinated fundraising forever. Company was growing, so it got to 30 million in annual revenue. And this this public giant would have like $1 billion in annual revenue. So we're eating their pie. We're getting there. First, they tried to legal strong arm us. They were sending all these lawsuits, these patent issues, etc., which were all wrong. But we don't have the capital to back our statements. And then they wanted to go through an M&A process. Meanwhile, obviously, they became too hostile, so the founders were also having these clashes between each other. But all in all, the company collapsed. And for me, it was bad because with $1.7 million raised, they went to $30 million in annual revenue. They went head to head with this public unicorn in the US. They had a fair chance. It's just that the war chest wasn't big enough. Should they have another $20 million of war chest in the bank, both to sustain operations, but also the legal portion of the equation, I think the company would have ended in a very different space, in a different place.
What was your biggest learning from this failure?
My biggest learning from this failure, I think, was that for some companies, capital is not a lagging, it's a leading indicator. A lot of some great founders, they raise capital and then they satisfy or fulfill the business to put the foundations of it. Whereas other founders, they have to capital always lags, where you go to this next milestone to unlock this new amount of capital, and then you have to go to this next milestone. If you're competing in a market where your competitor doesn't have any capital issues, but for you, capital becomes a lagging metric. And if the market doesn't change, because sometimes the market changes so drastically that these profitable companies end up becoming, it almost becomes like an anti-fragility layer for these companies. But in this case, the market didn't change. The one that doesn't have a capital issue would eventually win. And I think we should have pushed the founders even stronger to raise that capital.
So at the end of the day, it was really the war chest. A bigger war chest would have changed the game.
Yes, and it's sad because there's a lot of things that can go wrong. The team can go wrong, product market fit, competitive pressure, blah, blah, blah. The two things that hurt the most, I think, is one, founders' inner motivations, as I've said, but second is just capital not being available. Because
But
what you try to guarantee as a fund is that you want to make sure that all of your founders have more capital than their resilience. You want to make sure that capital is never a bottleneck in their ambitions. And then, sometimes it works, sometimes it doesn't, but it wasn't a capital issue.
when you see a founder having obviously personal issues with a certain part of the business, like fundraising, I mean, procrastination is for me a huge indicator that he might not like it so much and he has other preferences. But I never understand when I see teams where someone says, yeah, yeah, we do it, but then postpone it for a week, another week, a month, half a year. Why don't they just hire someone and put someone on the board who loves that part of the business? What has held this founder back?
First, like hiring someone who's gonna act like a chief of staff, investor relations, etc. A lot of the times at these stages are also red flags because VCs want the founder to lead that
Mm,
effort. A good scenario would be another founder leading it. A good scenario is there are like four or five founders, and then one of them is just better at this or wants to do it, etc. And then he or she would lead it. But in this scenario, it was more like a solo founder situation, which again, by the way, is one of the fragilities of the business. Having a solo founder means that these things do happen, whereas having four or five different founders just gives you more barrel, for all that ammunition that you're gonna need.
how would you manage then this situation? I mean, when hiring is a red flag at the end of the day and there is no founder, what's the solution then?
I think it's a mindset issue. I think if the founder had a different mindset or a different approach to it, and then if we were able to push him to that different mindset, it would take some. It would look ugly. It would look toxic, but I think it was the right call. We could have easily nudged the founder to switch the mindset. Make this a survival issue because it was a survival
Mm,
issue. It eventually
mm.
became a survival issue.
How can you push a person to urgency and make that clear that it's a survival issue?
Obviously, like from a financial perspective, from a financial metrics, Excel cash flow perspective, doing a fragility analysis there, etc., was easy, was already done. But I
Mm,
think the founder also had that you don't want to go bad with the founder. So whenever he needed capital, there was capital available from internal sources,
mm.
um, made him procrastinate more and more, which looked founder friendly and supportive in that, short-term thinking. I think in the long-term thinking, it just made the situation even worse.
Yeah. While you were speaking, I mean, there is this quote from Elon Musk that pops in my mind. He was said, hire for mindset because skills you can train, but mindset, you need the brain transplants to get that. And this is for me, I mean, when we talk about fundraising, my suggestion is always be in fundraising mode, always build relationships, always do your intel. And when you need money, then you already have the right people lined up and you just need to then play the game that you manage, or that you said, create some FOMO, tell them we need money now, 3 months, and then we are done. But always have someone on the team who plays that game and never steps out of it. And when I look at startups, very often they raise, then they build, then they run out of money, then they raise again. It just is always a disruption of the business.
No, for sure. It's a very Bay Area mindset. Might also, I mean, play in places where capital is abundant and you see all these founders next to you who are playing that game, you get FOMOed into playing that game, and then
Mm.
that mindset goes towards that. But if you're a founder based out of Istanbul, Bucharest, Sofia, it's very tough to stumble upon that mindset just because capital is not abundant, it's not readily available, and you don't have enough number of founders who are playing that game. You don't even know that that game exists. And the moment you clash to the fact that that game exists because you've just moved to the Bay Area, for example, sometimes you're a bit defensive, especially if you're doing business is doing well. And then our goal is to um, kill that defensiveness. That's hurting the business.
Never be on the defense, always on the offense. It's a really
Yeah.
good advice. I think, I mean, investing is an emotional roller coaster, right? How do you manage emotions in this high stakes game of investing?
To me, it's not. I mean, obviously, we're VCs. It's not that. I mean, it's a roller coaster for the founders. It's their only
Mm,
company, and it matters a lot for them. For us, we have a portfolio of companies. So obviously, one company doing well, one not doing well, either makes me happy or makes me sad. But there's a lag. I only learn about it 6 months later because
mm,
everything's happening day in, day out, and a VC doesn't know. And then because it's a portfolio, there's a buffer to it as well. You know, it hurts me less than it hurting me more. So I don't think it's actually a roller coaster for me. A company becoming a unicorn doesn't make me, you know, crazy happy because I mean your ego is not fulfilled because what happened? You invested in the right company 6 years ago. So maybe, I don't know, I should find a time machine, go back 6 years and congratulate myself from 6 years ago. But it's not my success today. It's my success from 6 years ago. And that guy doesn't exist anymore because it's been 6 years.
Mm.
Whereas a company going bust also, you know, feels the same because it's an investment you've made 5 years ago, for example. So I don't think from a roller coaster perspective on the portfolio layer, I go up or down. I go up or down on the roller coaster more from a founder perspective, how the firm is doing in general. And by firm, I mean the team, capital allocation, capital fundraising, our branding, our brand positioning. So those are things that I can control within my grounds, and they become more of a roller coaster for me.
How do you manage LPs? I can imagine that with the geopolitical landscape that we had in the last 5 years, we had COVID, then Russia, Ukraine, then we had Gaza, then we had Iran now. And you always see these ups and downs on the stock market. And I can imagine that also when fundraising with LPs, they also have their ups and downs because they also invest in the stock market. How do you manage that to give future perspective, to stay positive, optimistic, and keep them going and moving and investing rather than staying put and do nothing?
It's really easy to find all these excuses from, you know, COVID pandemic to SPACs to companies getting overfunded so that it's very tough for them to satisfy their value again, to the illiquidity of markets for the past 3 years, etc. There's always excuses, but I think all of these are just excuses. Because we're playing the power law game, I think the way to manage those expectations is to make them focus on one or two companies in the portfolio at any given time. It doesn't have to be the same company every single time, but as long as there are one or two companies that are doing tremendously well, then you're fine as a fund manager, you're fine as a fund. The moment there are no one or two companies that are doing tremendously well, and you're trying to manage expectations on a basket of companies who are, you know, all doing mediocre, then it becomes tough. So I think the way we do it is we just focus on one or two ones that, you know, have actually broken out. And with fund one and fund two, we had those breakout successes, which makes me a bit more comfortable.
So it's sunshining the breakout successes and highlighting what works well, even when the market conditions are tough.
Exactly. One to fund two, and fund one first 5 years was 2016 until 2021, amazing vintage. For fund two, it's been 2021 till 2025, not so great from a VC perspective. And when I look at fundraising graduation, revenue graduation, and the overall ARR TVPI of the fund two is better than fund one in worst conditions, in worst economic environment. And you know, telling that to people really resonates with them. And then in terms of putting spotlight onto a few companies, it really changes your return profile by a lot. If this company does 2x versus 5x, makes your fund go in by another 10x, you know? And that's when that's what you focus on and that's what you report on, it's much easier. It's much easier for LPs to understand, align, and manage what they're going to expect from the fund.
But isn't that concept hard to grasp initially? That when you say when you place capital into, let's say, 10 companies in the basket of 10 companies, and nine fail. I would say my Middle European, my Central European mindset would say, when you have nine failures, you didn't do well, my friend. But in investing in VC, when you have one great company, they can really, I mean, there is no end. When you have one NVIDIA and they get from 0 to 1 trillion in 10 years, just exaggerating, it returns multiple times your fund. But isn't that a concept that's hard to grasp for many people?
I mean, it's hard to grasp. It's either you have to give example of Sequoia and Sequoia's fund that had WhatsApp, which had the highest failure rate, but the best returns, blah, 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 or they see it. In our fund
Mhm.
one, Carbon Health, after becoming a unicorn, we had a $10 million fund where Carbon Health alone was 2.2x of the fund. So on a financial perspective, when they see it, you know, they grasp it. So as long as I think one company becomes about 0.5x of your TVPI, it's easy to tell people they understand it, they believe in it. But when you have five companies that are all, you know, 0.1x TVPI, although they're doing well, maybe you invested into 40 companies. So first they started as being 2.5% of the portfolio each, but now you have five that are 10% each. It's not, I mean, they don't see the difference between the two.
Yeah, yeah, absolutely, absolutely. What was your toughest challenge in these 10 years? Your personal toughest challenge?
Hmm. Good question. Um, I would say team building because doing investments in Fund One with my ex-partner, we didn't have a team, so it was much more sporadic, solo. You believe, you invest, etc. There was no pattern, there was no mechanism. And then with Fund Two, we obviously built a team. We have 11 people in the company now, etc. And the feedback loop is so long. Eventually, you're compromising the time that you can give to your LPs, which would in return help fundraising. Instead, you're giving to the team. The time that you can give to deal sourcing and deal making, which actually has, you know, impact, you give it to the team. And same with brand building. I see this brand as the foundation layer of VC, and then on top of it comes the two pillars of like LP part of it, and the so demand side, supply side, LP part of it, portfolio part of it. And instead of focusing on all this three, you're focusing on the team who hopefully are gonna in reverse are going to make you stronger in the long 3 to 5 years time. I think that was the toughest part of it. I still don't know whether um, a lot of the funds you would see that partners or GPs would be writing checks and other people would be doing the legwork until they become partners or GPs, which isn't what we do. So in our case, the team is very horizontally spread. Everyone does startup, everyone does deal sourcing. For everyone, it's 60-70% deal sourcing. And every single second meeting with the founder is with a GP present, together with an analyst, associate, principal, etc. And when we write the check, it's our deal together with the GP and, for example, an associate in this case. With this horizontal culture, you expect everyone to source good deals, to find those right networks to get into so that they build a brand for themselves and then they source the right deals. That takes a long time. So that's been the toughest challenge.
I'm curious. You have a lot of experience in VC, you build a team, and I like this 80-20 principle. This, when I look at companies, this 20% of activities that create 80% of the returns. My question to you is, as a VC, what are the 20% of activities a VC team should do to create 80% of the results?
Deal making. In fact, I sometimes believe if it's 80-20, it's good. Sometimes it's 20 to 150, where the other 80% of what you're doing is actually diminishing your value that you've created in that 20% of it.
Really?
100%. I'm scared that anything that we're doing, which is not deal making, because deal making builds track record, deal making builds network. Deal making, you have to do deal sourcing, so it increases your exposure. And then deal making also fulfills your brand, and brand is the only moat on a venture capital doesn't have any moats apart from brand building, and that takes a long time to build and a long time to diminish. So the VC funds who are not doing that well today are probably gonna diminish in a very long time. It will take another 15 years for them to close shop. So from that perspective, I think deal making is the only thing that matters. And then anything that feeds into deal making, I would put into that category. And that's where the 2080 lies in.
So it's basically talking to founders all the time, finding better deals, finding better networks, being active, being out on the market.
Yes, and doing deals. Because a lot of the VCs, when they become venture capitalists, um, they have to be convinced into doing a deal. So some VCs would actually spend 2 years, 3 years. VCs, I mean individuals who just joined a venture capital firm, wouldn't do any deal for 3 years. So for those people to fulfill their ROIs, that first deal that they do better be a unicorn, because
Mhm.
this is a game of doing a lot of bets. So you have to feel comfortable and owning your mistakes.
So you really mean deal making, closing deals, signing checks, even when you feel you don't have all the information yet.
Yes, dealing with that unknown is more important than knowing itself. I mean, this is a game of dealing with the unknown.
So it's the core activity that you recommend to VCs is make deals,
No,
sign checks.
exactly. And for a new grad or a junior person who's just joined the VC fund or is looking to join a VC fund, try to do deals. You're gonna learn so much, and there's no other way of learning. I don't think anything you'll read, hear from people, etc., is gonna matter as much.
But this forces when you hire someone, this forces them into making decisions as well. It's not only, I mean, a deal is a decision then.
Yes, so actually, for our team, we want them to push deals. Eventually, it's our call.
Mhm.
we need that push. We need that if they're very highly convicted about a founder that they think this founder is great, irrelevant of what we feel, they have to nag us in and out, in and out, in and out, make their case, make their case. And we'll never judge them for deals that turn out bad. But if there's a good deal that they missed or they haven't pushed hard enough, it's a career breaker for them. I mean, they are, God knows where their career was going to be.
I read that also in the venture mindset, Bessemer Capital called it the Bessemer Venture, I think, called it the anti-portfolio. How important is that?
It's
The deals that didn't work out.
Oh, that didn't work out because for us, anti-portfolio are companies that did super well, but we didn't invest in them.
Yeah, also
Um,
this one, these two
yeah,
mistakes. They didn't invest it and didn't work out, and the other one, um, you had it on your radar, but you let it pass.
it's important to have those because it shows access. For some funds, they don't have large anti-portfolios because they didn't even have access to those opportunities in the first place. That's the
Mm,
worst. The worst is when in your mandate, in your geography, there are unicorns that are not in your portfolio, but also not in your anti-portfolio. Is like, what were you doing with your time? We have a lot of anti-portfolios, especially in Eastern Europe. One of the
mm.
things that made me build conviction on Eastern Europe is I've looked into a lot of deals that were around for a very long time. I wasn't able to pull the trigger because I felt like I didn't have a firm grasp of the ecosystems, and then a couple of them did super well. And two of them actually, I also spoke with a lot of experts in the issue, and a lot of the experts were naysayers. I don't trust experts. I mean, I don't, they will tell you 100 ways why this is not going to work out, but all you need is this one way where it is going to work out. And I think that's their blind spot. That's why they are experts. They're not builders. Um, so yeah, that's why we doubled down on Eastern Europe actually, because without a specific mandate, with a mandate, if you had to do 20 deals in Turkey, you have to do it. The way you do it is every single best deal you've seen in the past 3 months, you have to do it, or 6 months maybe, you have to do it. Otherwise, you just think it's not good enough. It's not good enough, which was the case for us in Eastern Europe. I didn't feel mandated to invest.
Mm,
There was
mm.
no push to me to investing. So we rebranded the fund, focused on Eastern Europe, just so that we created that mandate ourselves.
But isn't that annoying at the end of the day for a VC, when we stay a little bit with this anti-portfolio approach, that you had a deal on your radar, found internally that you don't invest in that deal, particular deal, and then it becomes a unicorn?
It happens a lot. It's very sad.
But how can you approach this situation to learn something to do better next time? What's your approach to this anti-portfolio thinking?
Yes, in some of the cases, what we thought was that we were very bullish on the founder, but we end up not writing the check. So if you're bullish on the founder, you should write the check. So it kind of increased the weight
Mm.
on the founder. And then brand signaling and what the other VCs think, etc. For some of these companies, they were in the market for a while, and local VCs, weren't doing the deals. But it's a very shallow market. It's not a functioning value chain. I think in functioning value chains like the Bay Area or London, you have to listen to the market. The market says something. But in very shallow and non-functioning financing value chains, like in Romania, Bulgaria, etc., you shouldn't care what the market thinks.
Why did you expand from Turkey, your core area, to Eastern Europe? What was the motivation to include that in your thesis?
Yeah, so our thesis was very US focused. We would invest into founders who have a very US first approach. And
Mm.
when you look globally as a region, Eastern Europe is where this is already being done. We couldn't have it expanded into the Middle East, Southeast Asia, Latin America, etc., because they were investing into very hyper local businesses, which wasn't core to our thesis, but Eastern Europe was core to our thesis, where we would be leveraging the brand, our San Francisco presence. We have an office in SF. We have one person in SF. So all of these things were assets that we can leverage together with our thesis in Eastern Europe.
Oh, that's great. How do you see Eastern Europe today?
Eastern Europe, I think from a unicorns perspective, you would see a lot of amazing companies coming out of Eastern Europe, all of them with a US first or a global first approach. And just like the rest of the market, they're all lined up for IPOs. So I think we're going to see much more IPOs that are going to happen in the next, say, 2 years. What was good about Eastern Europe is they had that anti-fragility. So capital was never to their advantage. Capital was to their disadvantage. Because of that, they had much better unit economics, much better profitability, etc. in their businesses. So when the music stopped, when the market turned 2.5 years ago, all of their competitors crumbled, whereas they rose. So I think we would see that a lot of the Eastern European companies who are number three, number four in their respective industries are going to become number one from a valuation standpoint, just because of how cash efficient they've been for a decade now.
You mentioned that we will see a lot of IPOs from Eastern European companies. Um, in Europe or in the United States?
80% US. I think it's either US or the UK.
Mhm.
It's more the question because a lot of Eastern European founders either moved to the UK to start companies or expanded to the UK after they started companies in Eastern Europe. For that portion of the market, UK would be more relevant, but 80% of the case, it's still the Bay Area. And
What must what must happen in Europe that it becomes a natural decision for European founders to stay European, on also on the capital market?
impossible. I think the whole bureaucrats, regulations, how fragmented every single market is, uh,
Mm.
etc., should change. So I don't see that happening in our lifetimes, to be honest with you. I can see how the US market wouldn't do as well. I can see how Euro can do much better than US dollar. But that making such a big shift, so much so that founders who are going to build in US would actually not go to the US and stay in somewhere in Europe throughout the cycle of a business. And this decision being the right decision, I don't think we'll see it.
Okay, okay. It's not satisfying for a taxpayer perspective, but understandable from the corporate builder perspective that
I
in
think the
Nasdaq.
taxpayer also wants this. I think the taxpayer in Europe also would rather have 100 companies with $1 billion valuation than one company with $100 billion valuation who's not paying that much tax. So the Europe taxpayer also wants these companies to go not go tremendous, so much so that they can lobby the government and then ease or optimize their taxes, go international, etc. Europeans also don't want that.
I mean, but correct me if I'm wrong, of course. The problem I see with that thinking is that in Europe, we have Horizon Europe, we have a lot of local public funds, tax money that goes into the startup industry, which is fine, and it helps really moving the companies forward. Sometimes they become a little bit too government addicted and bureaucratic, but they also create a lot of interesting companies. And then from a taxpayer perspective, what happens is that the companies grow. Of course, then they switch over to the United States and make an IPO there and move also the majority of the team or start building the majority of the team in the United States in the end of the day. Which means when I think it through that when this company goes public, becomes a huge success, has a lot of revenues, there is not so much tax returns on the European side at the end of the day. We invest a lot, we take a lot of early risk from tax capital, but the returns happen then for the United States tax pocket and not so much for European tax pocket.
Yeah, I think Europe is a great place to spend money. So irrelevant of whether you're European or not, or whether in
Mm.
the example, in your analogy, the taxpayer gets back to Europe or not, the wealth is created and is going to be spent in Europe. And for that's also true for a lot of the American wealth that's also created, by the way. It gets returned and being, spent in Europe.
Yeah, hopefully. But when you are in the United States, is there a reason to come back?
Yeah, sure, sure. But
Ah,
then these companies and founders, etc., also, optimize their taxes much more in the US.
That's true. That's true. When we go a little bit back in the conversation, you mentioned we talked about the anti-portfolio and also the habits that can kill a fund. When a new VC approaches you and say, "What are the free activities that I should do to kill a fund quickly? What are the most toxic activities a VC can do?"
Not being focused on your venture capital activity is one thing. I think it would kill a fund, both from a deal sourcing perspective, team perspective. There are three layers of it: the deal sourcing, the team, and the LPs. You would basically be ruining all of it by not being laser focused on your core activity. Reputation. It's all about reputation, like not being focused on your fund activity is one way to kill reputation, but there are 20 different ways to kill reputation on any side of the equation. And it happens to all of the VCs. So second would be reputation. And I would say the third would be trying to control companies. So the more you think you're better than the founders and try to put that founder head on and try to do portfolio support, try to navigate decisions, try to talk about marketing strategy, go to market strategy, product strategy, etc. with the founder, You don't know when you've crossed the line, but if you've crossed the line, it's already too far. That would affect your branding, that would affect your reputation, that would affect your portfolio, that would affect the psychology and the mentality of your founders. And I think a lot of the first-time fund managers in places where there are not enough fund managers, especially in places like Eastern Europe, do fall into that trap of they think they know better. It's just that they know the chat GPT answer to a lot of the questions.
But isn't that a trend in VC in recent years? I always read about these value-added VCs who said, we want to work with our founders." Um, h- how 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 do we approach this?
The real value is the value that you provide to a founder without adding any value. That's signaling effect. The fact that a fund has funded you might have might lure more talent in just because the fund has backed you. It's better for your employer branding. It might be good for your visa if you're moving to the US. That name opens a lot of doors. It might be good for customers because a lot of these customers would have this false sense of confidence in your product just because this one fund has backed you. I think that's like nine, or other funds would get FOMO'd into investing in you just because this other fund has backed you.
Mhm,
I think
mhm.
that's 99% of the value. 99% of the value is the value that you provide without, moving a finger. That just comes with your presence of being as a part of that company. And then that's not the only, I mean, not every fund has that. So you try to do your best, hustle for the founder, do introductions, meet with other VCs so that you do these close contacts so that when the right time comes, you do those introductions, etc. But these are small fine tunings. These wouldn't make or break a company. I don't think any actual VC support would make or break a company, but the ones that actually have a big impact are the types of values that the VC does without doing anything.
No, I totally agree. I totally agree to what you say. I think the signaling is very important. Um, but then you often experience that VC gets a board role, and then it becomes tempting to say, no, do this that way. No, let me make the introductions to VCs. And I make the introductions to industrial partners, and the VC slowly grows into an operational role. How do you stay emotionally out of that?
Yeah, I think it comes with learning. Like so you have to people cross that line. Then they realize that it's bad for performance, it's bad for relationships. Some founders do try to push them out, and then it becomes a clash, and then
Mm,
they learn. I think for that persona of a fund manager, they they wouldn't learn it by how like smart people learn from other people, whereas for dumb people you have to see it for yourself. I think they have to see it for themselves.
okay, okay. And the second part that you mentioned is, I think the buzzword is complacency, that which I think is always a danger when success sets in. In the beginning, you close your first fund, uh, nobody knows you, you are not successful yet, so it's easy to stay focused and work on the tasks that move the things forward. But then money comes pouring in, you become more famous, people know you, people greet you on the streets when you fly to San Francisco, they recognize you, you get to know the big names, you close the next bigger fund, you become really famous. And then isn't that a danger that complacency sets in and distracts the entire team from the core focus, from the core function of a fund? How do you avoid that feeling of complacency in your fund?
By feeling that you're not by not being satisfied of what you've done kills complacency. And then I think you also you surround yourself with people, or you anchor yourself into a group of people in your mind where you're the inferior, which also kills complacency. And at least for us as a fund, I feel like we're not a firm yet, we're still not a brand yet. Our success of backing a couple of unicorns have been very sporadic and just out of luck. And then, whether this firm is going to exist 15, 20 years from now, I have no idea. And to get to the next level, now we're raising our third fund. It's $100 million fund, which I can see how we're going to raise. Whether that fund can go from 100 to 150 million, I can see that happening too, but like that's where the ceiling is, at least for us. So what is that next step? I have no idea. Can we ever reach that next step? I have no idea. I think that mindset would, kill complacency and make you feel inferior in a market, and I think it's good.
You are in the process of raising your next fund, or do you have plans to raise it?
No, we are in the process, so we'll close it in the next 3 months.
Cool.
It's a $100 million pre-seed fund, also focused on the Baltics, Eastern Europe, and Turkey. Same strategy: pre-seed, seed, $1 million average check size, 40 companies.
So is there still room to invest when somebody listens to the episode to the live stream now, or are you already done?
No, there is room to invest. I wish we were done. We're not done. It's a very fragmented LP base. So we have 116 LPs in the fund.
Mm.
Out of that 116 LPs, I would say about 35 of them are founders themselves. So we're being backed by a lot of founders, but then we also have DFIs like EBRD, IFC. We have 20 different corporates, five banks. So it's a very diverse group.
What's your focus with the new fund? Are you still, you mentioned in the material that your first fund was focused on mobile gaming. And what's the focus of the new fund?
I would say we will do 20% mobile gaming. So the two we believe that there's a lot of mobile gaming talent in Turkey, is one
Mm.
thing. Second is we believe there's a lot of technical talent in Eastern Europe and Turkey. So 20% of the fund would be mobile gaming, 80% would be technical founders. And what those technical founders are going to build, I have no idea. For now, we're still betting on AI. But 6 months from now, and I don't know what we'll be betting on. So it's more, I mean, we have lingered around dev tools and AI with fund two. With fund three, it might be quantum for all I know. I have no idea.
Is mobile gaming still a thing?
I'm not sure. So I'm not very bullish on mobile gaming, to be honest with you. Then you might ask, why are you investing into mobile gaming? First, because I'm not thesis driven. If I was
Mm.
thesis driven, I would have a bearish view on mobile gaming. Two, let's say I'm not, I mean, can I short mobile gaming? I can actually not short that asset class. I can not invest, sure, but that's not the same. And then third, I can make this statement where the best Turkish founder I've seen in the past 6 months is also one of the best in the world. I can
Mm.
easily make that statement. Turkish talent is so top tier. I cannot make that statement in any other industry, in any other country. I cannot say the best biotech founder out of Hungary is one of the best in the world. No, maybe it's the worst founder in the world, or the best AI dev tools founder in Turkey is the best in the world. I cannot make that claim, but Turkey has that talent edge where I can make that claim, which pushes me to invest more and more into mobile gaming.
Yeah, gaming is always a thing. I think gaming is one of the oldest industries in the world as well. So people
It
like
is, and a
entertainment.
lot of the consumer adoption, consumer iteration, new technologies, etc., come through gaming. And you see these either platform shifts, medium shifts, or technology shifts that disrupt the market, enable new players to become unicorns every 5 years in gaming.
How what's your take? I mean, you're an expert in gaming, obviously. Um, 80s, there was always these linear games. It was Commodore computers and then was the Microsoft-based machines, but it was always very linear. Now we have Alphabet, they are free. Now we have LLMs. How do you see these tools influencing the gaming industry?
First of all, I'm not a gaming expert. I think if there's one thing I know, it's mobile puzzle gaming. So it's very specific.
Mm.
A lot of the Turkish success stories in mobile gaming has also been mobile puzzle. And that's the field I know, all the different mechanics, core loops, different games that you can play, different games meaning different strategies you can employ, etc. I have some idea of. Apart from that, I have no idea. In terms of your question around LLMs, I think it's gonna hyper optimize gaming, which is gonna increase the upside potential because lately it has become a very low margin business, which was also implied by the valuations, especially in the public markets. A gaming $100 million business is not the same as a AI or a SaaS or a dev tools $100 million business. There's this very large discount on that revenue multiple. If not, it becomes an EBITDA multiple, and there are reasons for that. But I think that hyper personalization can drastically that comes with LLMs. And this is hyper personalization in levels, assets, monetization, whatever it might be, is gonna increase the upside potential where you're gonna grasp more of the money you're leaving on the table because there's a lot of value that's created with mobile games, and there's very few whales that actually pay for the amount of value that's created, whereas the rest of the probability spectrum the company ends up leaving money on the table, creating more value for the end customer than the value that it gets back through monetization. I think that's gonna, get more optimized.
You said before, you mentioned briefly biotech, that we have good tech people here in Europe, and they would fully subscribe that, especially in biotech and other deep tech areas, that we have a lot of technical driven founders. What I sometimes miss is what makes them a founder, in my opinion, is the business and entrepreneurship mindset. How do you perceive our tech-driven founders? Do they have enough entrepreneurial spirit, business mindset, or compared to San Francisco? Or is there something that we can improve here?
No, they're definitely not that entrepreneurially spirited, and I think it's very tough to change because it's in the core of how they. For you to become uniquely positioned in your space, say in biotech, takes a decade, if not more, and by then you're 35 years old, and you've been surrounded in an environment where some things are valued and some things are not valued. It's very tough to change that afterwards. And for a lot of the European universities or R&D centers where a lot of this R&D activity happens, they're surrounded in an environment where entrepreneurial spirit is not as cherished, or failure means a lot, success doesn't mean much. Also goes for, wealth generating, or fundraising, or creating a company, etc. Whereas in the US, those are things that matter eventually. That's the environment that this uniquely positioned person's character is built upon. And then when they decide to become a founder, they have all the right ingredients from a mindset perspective. So I think it's very tough to change after 35. And I'm not saying that Europe cannot change that. I'm just saying that you cannot change that on a personal level.
How would you coach a founder when you say there is a potential, they have a great idea, they have the tech, but they lack the entrepreneurial spirit and business mindset, and you know the environment in San Francisco? How would you approach this situation?
A lot of the times those founders are happy with themselves, and being happy with yourself might be good for your psychology, might be good for your relationship, your family, but it's not good for business.
Mm.
In the business world, you have to always surround yourself with people that you aspire to become, and when you become them, you've already reshuffled the number among the people around you where you're still inferior, you're trying to go overreach. A lot of our founders, also the one in the biotech space, hopefully when they're going to become public and they're a company that does more than $200 million annual revenue, he feels so inferior. He's like, I want to build a generational business. I'm not even a 10-year-old business yet. My competitors are generating billions of dollars of revenue. I'm nothing compared to them. And this is a company that's, a billion-dollar company. That mindset is lacking in those people that you've mentioned. And a lot of the times they are happy in the environment that they're in. They see themselves as top quartile, top decile in the society, in their university, etc. And then that puts a ceiling on your potential.
Okay, so for the VC point of from the VC point of view, then simply not investable at the end of the day. When
For me, yes, I don't think that those are things I can change. They have to change to validate. So if for a founder like that, if she um, moves to the US, spends another 2 to 3 years, surrounds herself with the right people where she feels inferior, so that she starts to go out of her comfort zone to grow in these areas where she's never grown or she's never flexed her muscles. That might change my perspective, but all of those things have to happen before I change my perspective.
and for investments with a new fund, that does matter a lot, that this entrepreneurial mindset is established in a team before you invest.
Definitely, definitely. Because at the end of the day, we're backing founders. By the way, this is something we discuss in mobile gaming in Turkey a lot, where we're seeing a lot of great founders,
Mm.
a lot of great product people who are not founders, and there's like a lot of them. So I'm looking into 10 deals with founders who have built games, became successful. They know how gaming works, but they're not founders. And then how am I going to pick? Should I not pick, just invest in all of them, or should I start picking? Which brings you back to the core question. That brings you back to the fundamentals of like, are these founders? Do you believe in their entrepreneurial spirit? If not, then you shouldn't. And then we try to pick on that parameter.
What's your definition of entrepreneurial spirit? How do you measure that for your investments?
It's very tough to, I mean, there's a lot of different parts of it, and it's very tough to gauge, but pragmatism, being practical, being comfortable with going out of your comfort zone, always changing what you think, that, it might also be pragmatism, but, iterating on your thinking throughout your process, resourcefulness. For example, previously you've asked me about reaching out to me, get introductions, etc. If a founder cannot find a mutual who's going to introduce us, I mean, that's the easiest part. Founder needs to be much more resourceful than that, and you would see that when you talk to different founders. It also comes with their aspirations. Why are they building the company? Because sometimes it seems easy, it's not. And a lot of the founders that I see, especially in mobile gaming, want to become founders just because they feel like it's time. It's the time that they try as well. That's a very bad reason to start a business. So you try to stress test those areas.
You mentioned comfort zone. Um, I think successful people are never in a comfort zone, really. But I can imagine Jeff Bezos starting Amazon and then moving it up the value chain. There's always something new to learn, and it's never time to settle. But how do you measure it when you see a founder? How do you find out how adaptable they are to new challenges? How comfortable they will feel when something happens around them?
Yeah, I think the first 5 to 10 minutes of a meeting with me is a bit traumatic for a founder. It's not that pleasant because I try to shake their grounds and see what's left. And when I'm shaking their grounds, I'm really putting them out of their comfort zone. It's sometimes more on a personal level, where I'm asking them about their relationship with their families, etc. Sometimes it's on the business layer where they've spent a lot of time working on this, and I'm just on the core attacking it, saying that I don't believe in this and this and this and this. And then you start to see that person maneuver with that shaky ground. That tells you a lot. And then there's also things that you check on the face value that shows you how adaptive they are into new environments, going out of their comfort zone, etc. Like their career, their college, what they've chosen to study, and then post college has all these different clues that you're trying to take out of it, or the way they found their co-founders, how challenging are their co-founders to them, etc.
So you pressure test them in the first few minutes.
Yes, and then if it fails, it failed, and then I end up with a bunch of founders that hate me for it.
That's life. That's life. I mean, it
Yeah.
can't be everybody starting. I think your cat, was it your cat that was briefly saying hello?
It's my parents' cat, but yes, so we have a bunch of cats in all of the different locations. This cat is the cat in the summer house.
Oh, yeah, I have two cats too, so
Nice.
I was
Yeah,
aware
I
of
also
that.
have to back home.
Um, we are in the final part of our conversation. I have a few questions left, if you have some time.
Of course.
Um, you know San Francisco, you operate out of Turkey. And what I found amazing in the last 2 or 3 years is that I changed completely my perspective on Saudi Arabia and United Arab Emirates. I always tied them automatically to the oil business.
Hmm.
And just thought petrochemical industry, when you have something in that area, you can send them. I'm more in deep tech, biotech. I don't have anything for them, so check it off the list. And then I had a few interviews, and they said, no, no, they are changing. They are investing in much more areas, and they are building ecosystem there. From your Turkish perspective, how do you see the activities in Saudi Arabia and Dubai, for example? Do you think that can be the next solution for Europeans to not only look towards San Francisco, but also into this area when they want to scale up with investments, when they found, and especially Series A, B, C, D?
Yeah, I put companies into three different categories. Some companies, just because of how blue ocean their markets are, they're very Bay Area first, and they have to be US first, and they become unicorns being US first, and then they expand globally. For those companies expanding into a market, um, like Saudi Arabia, for example, would become after they became unicorns, they would be expanding into Europe, and why not try Middle East? Maybe it's also for capital raising reasons, because some of these capital sources do want some presence there, and then you just satisfy that. It makes sense, but you only do that after you've become huge. But that's for companies in blue ocean spaces. For companies that have a hyper local play, these would be regional accounting software as a service companies, HR companies, about a lot of the local marketplaces where the transaction happens locally, like Uber clones, for example, etc. You either start in the Middle East or you don't. You cannot expand there because it's a hyper local business. So
Mhm.
someone else would be doing it there anyways. There's no need for you in the market. And then there's a third type of a company, which is starting in a red ocean market, meaning they cannot target the US because it will be too late. Probably 10 other companies are already executing that business in the US. It would be suicidal. So they have to expand globally. And then while expanding globally, should they go to Singapore to expand into Southeast Asia? Should they try India? Should they try Middle East? Should they try Latin America? Middle East is definitely one that's in the priority list. As a UK, British, or a European founder, I would try Middle East, which would A, because they like playing with these technologies. B, they have the budgets to back it up. And then C, it would ease out your fundraising in the long run as well. So I think for that third type of companies who are starting in red ocean markets, who want to expand globally early on, it's not like they can only focus on Germany and become unicorns. No, they would get to Series A in Germany, but then they would have to open multiple offices. One of them would be Riyadh or Dubai.
Mhm. With local investments. You mentioned a couple of times blue ocean companies, blue ocean strategies. For listeners that are not familiar with this term, can you give your definition? What's a blue ocean company?
For me, a blue ocean market is a market where there's not that much competition because there's no market to speak of. There are no enterprise budgets. It's just the early ironing of a technology, and there's a lot of different enthusiasts playing with the technology, and some developers and some corporates are playing with it as well, but nothing
Mhm.
substantial. And then when you try to build and build and build on this category, and if this category explodes, you become a massive winner in the space. Whereas red ocean markets are markets where there's a certain need, there's a market, there are competitors, there are some companies who have become unicorns, some that went public, etc. But there's always these small niches or nuances or regional differentiations that you can execute to, find a place for yourself. Those would be more red ocean companies. In those red ocean companies, it would be very tough to go and start in the US because the
Mm.
market would already probably be taken by a handful of players.
So it would be, for example, CUDA from NVIDIA would rather be a blue ocean strategy and red ocean strategy iPhone, already existing market mobile phone in 2007.
Yes, correct. Or looking for, yeah, I mean, cloud as well. For example, building a cloud provider post 2010 would
Mm.
be a very, very red ocean strategy.
And so your assessment basically is that the Bay Area is so far ahead for blue ocean market strategies, mindset, talent, capital availability, understanding that even Saudi Arabia, with their massive cash flow from the oil industry, won't be able to compete soon in the future with that
Because I think
ecosystem.
for you to become, for a region to have a lot of for a region to have a lot of appetite for blue ocean technologies, it
Mm.
needs to have high enterprise budgets, which sure Saudi Arabia can. It needs to have a lot of R&D offices in the region. I don't think Saudi Arabia has. And it has to have a very liberal economy with a lot of competition, where the giants are just competing and clashing with each other. So they're investing in the next 10 years. They're not just investing for today or to optimize today's top line or bottom line. They're investing for the next 10 years of their companies. Those three components don't exist in Saudi. Even the examples that you give in terms of oil, etc., are very monopolistic, oligopolistic structure.
Mm. But they don't exist in Europe either at the end of the day. I mean, we had
I,
something in the 90s, but now,
yeah, there's not enough business turnover on, any
yes.
part of the ladder in
So
Europe.
it's natural. Everybody who listens to the podcast, everybody who thinks they have a blue ocean strategy with their company should reach out to you, and you can help them at the end of the day make the big leap towards San Francisco, get the company off the ground, move it forward.
Exactly.
And then later, when they flip the strategy and when the market exists and we are entering red ocean territory, then you can also help them coming back to Europe.
Exactly.
Yeah.
Exactly.
And this is not going to change pretty soon.
No, I think this is core to our strategy.
Yeah, it's bad for Europe, in my opinion. I think we have a lot of potential here in Europe. We should do more with it.
True. I think what's good about Europe is talent is everywhere. It's very
Mm.
fragmented and bits and pieces slide all across the continent, which is good from an opportunity standpoint, which is good to scale talent. You have to adapt to this. If you only need 10x engineers that are best in the world, but you need a lot of people who are very talented, etc., Europe is a good place to build that tech backbone. It's not bad. But then again, I think that tech bone needs to be building for the US, not for Europe.
Before I come to my last two questions, is there any topic that you would like to discuss at the end of the podcast that we didn't tackle yet?
No, I think that this is all good.
How can founders reach out to you?
LinkedIn, Twitter, email, all of it would work.
And at the end of the podcast, what's your final message to founders that you would like to leave them with?
Our thesis is bridging to the US, but then a lot for a company, for a founder starting off in Romania, Bulgaria, Hungary, Turkey, etc., they have a lot of issues finding early adopters. They have a lot of issues raising pre-seed funding, seed funding, finding the right talent, etc. Let's all bear in mind that all of these are a direct consequence of being based out of Turkey or Hungary. So you can build your company here, you can scale your talent ops here, but you have to, make that move and get your first customers in the Bay Area so that that's where you anchor your product, and then everything is going to be, dragged by it.
Enis, thank you very much for this conversation. I completely agree to everything you said. If you have a great company, if you want to go global, go to the United States. have a team here in Europe, but at the end of the day, you need to build in the United States. That's the situation.
Yes. Well, thanks for having me. This was great.
Thanks for your time, your candor, and your vision. And I can't wait to see who reaches out to you hearing this podcast. And let's stay connected and let's stay in touch.
Ciao.
See you. Bye bye. If today's conversation shifted your thinking even a little about what it really takes to build world-changing companies, you are not alone. We heard how mindset and ambition, not just capital, decide who leads in the global arena. We learned why relationships, resilience, and the power law shape everything in venture capital. And Enis Hulli left us with a truth few talk about. The best founders never settle and they never stop growing. If this episode helped you, made you rethink your own path, or gave you a new tool for your journey, share it with one person who would benefit from it. That's how this show grows, by word of mouth, from one ambitious mind to another. If you share it, please tag me on LinkedIn or your favorite social platform so I can reshare your post with my network. And together, we will bring even more industry leaders and visionary voices to the table. And if you're hungry for more, stay tuned. Our next episode goes even deeper into the mindset and mechanics behind extraordinary results. Thanks for listening and see you next time on this channel.